Hello and welcome back for the second video of our Investing Fundamentals series. Previously we talked about outstanding shares and now we're going to be talking about float. And you may be wondering why there are two of those. Why do we have a float and outstanding shares? Why not just have one? And there is a very important distinction for which we're going to be talking about in this video. So what is floating stock? Let's take a look at Investopedia. Floating stock is the number of shares available for trading, that's very important, of a particular stock. And floating stock is calculated by subtracting closely held shares and restricted stock from a firm's total outstanding shares. So total outstanding shares, you may think about it as the total amount of shares that are being held by the different stockholders. That's basically what it is. But a float gets this number, the total outstanding shares, and subtracts the closely held shares in restricted stock. Why? So for instance, there are some shares, let's say restricted stock, that is meant to be paying employees of a company. It's like stock options, for example, or employees are being paid as part of their compensation, some amount of stocks. So these stocks are not traded in the open market. However, they are part of the outstanding shares because they have been issued. And so these are two different metrics that have different applications. Generally speaking, total outstanding shares is more important for fundamentals and value investing, while float tends to be used more in trading, and especially like day trading. And there's a very important reason for that. You may have heard of people who are doing day trading that are looking for low float stocks to trade. You may have heard that expression. There's a reason they are doing that, but what is that reason? So picture two kinds of companies. One company that has a massive float, like Apple, which has like 16 billion shares being traded in the open market, which is its float, and another company, whatever company, that has like 50 million shares being traded in the open market, which is its float. Now, which of the two companies will be enjoying, let's say, higher price fluctuations? Typically, the company that has a low float tends to witness more price fluctuations and steeper price fluctuations. Why? Just because there is less of it. Like if you picture a pool that has like 16 billion things, there's obviously more options. So there are more traders, and even if there is the same amount of traders, there are still more options. So the more options you have to trade from, the less steep the price fluctuations will be, because there's gonna be more trades. It's gonna be, the book of trades is gonna be happening more and more and more and more, and there's gonna be many more options to exchange with, many more sellers, many more buyers. So it makes sense that a lower float tends to lead to higher price fluctuations, because high float stocks are more heavy in their trading. This is why you are looking at some companies like Costco, for example, which have massive floats that are not moving too much during the day, unless something really important happens. But if that same thing happened at a company with a lower float, it would normally move much more steeply. And so this is a very important reason why float matters to traders and not so much to investors. And you can see it here also in the key takeaways that Investopedia mentions, that the floating stock refers to the number of shares a company has available to trade in the open market. And low float stocks tend to have higher spreads and higher volatility than a comparable larger float stock, what we discussed earlier. And also investors can find it difficult to enter or exit positions in stocks that have a low float. Again, because there's less shares being traded actively, it may be tougher to find shares at your price levels, for example. And so you can see here an example that I was taking a look at for Apple. You can see that the outstanding shares of Apple are 16.41 billion and the public float is 16.39 billion. So there's not much restriction there. Most of Apple's stock is traded in the open market. However, you see here that this public float is massive. There is a massive amount of shares that can potentially be traded daily. And so this generally points to smaller fluctuations, again, because there is a very, very high float. And so this is what I wanted you to get out of this lesson. realize the difference between floating stock and outstanding shares, and understand that as a value investor, we typically care about outstanding shares more than the float. But if we are doing day trading, we tend to look at the float just because it gives us a better idea of how many stores are actively and can actively be traded, and can point us to stocks that can have more of a boom, more steep movements during the day. So that was the second video. Hope you enjoyed it. Stay tuned. You may want to subscribe because there's gonna be a lot more videos about all sorts of different principles and formulas and any financial information that can potentially help you with making better and more sound decisions for your investing. Thank you for watching, and I'll see you in the next video, guys. Bye bye.